Well, we got gross domestic product numbers for Canada late last week. Those numbers showed a much stronger Canadian economy than economists had been expecting. Let's talk with an economist now who is expert in the numbers for his view on the numbers and challenges facing the Canadian economy. Joining us from Toronto is David Doyle, head of economics at MacQuarie Group. David, thanks a lot for joining us. So we did see very much stronger gross domestic product numbers than we were expecting last week. The fourth quarter number came in at growth of 2.6%. That was 90 basis points more than the street was expecting. The monthly numbers also came in higher than expected. What's your take, first of all, on that unexpected strength in fourth quarter economic growth here in Canada?
Yeah, Paul, so certainly welcome news. We've had a struggling economy for the last several quarters in advance of that. So to get something that was better than expected, good news, and it was driven by final domestic demand, particularly consumption and housing investment, which I think the Bank of Canada would be happy about, given it shows some signs that their interest rate cuts are having some positive impact. I would caution on the sustainability of the gains, though. We've already seen home sales start to roll over in the first quarter of this year. So it looks like that data actually will work the opposite way in the first quarter of 25. And then, of course, there's also knock-on effects from home sales for consumption. So we're still cautious on 2025, but of course, welcome the good news for the last quarter of 2024.
David, I'm sort of curious in terms of, I agree with your outlook on the Bank of Canada as well, and cutting rates further too, that I think you've mentioned in your notes. What I wonder about at a point, given the spread to the U.S., whether the currency is going to be at risk. So far, the Canadian dollar has been weaker, but it's actually surprisingly strong a little bit in my view, given the tariff threats and everything else. Is there a point where the currency becomes a consideration for the Bank of Canada in terms of how much more they can cut if the U.S. is not cutting rates?
Yeah, I mean, I think we do. There is a point where where we'll get to that. I don't think that will interfere with their decision making over the next few months, though. It could be something that weighs on them later in the year. But I think a lot of this is intertwined with the threats of tariffs, right? So if you get big tariffs implemented, then the currency will probably weaken more. And then the Bank of Canada is kind of in a pickle, right? It sort of has higher inflation resulting from tariffs and the trade war, but at the same time, weaker growth and a weaker currency that will compound those inflation issues. So that's a tricky scenario for them. In our baseline, what's happening is that you get some tariffs, but not something that is enormous or sort of catastrophic for Canada's economy. And in which case, the uncertainty is what hangs around, and that has more of an effect. So there's more of an effect on growth than inflation. The currency actually might not do all that bad in that scenario because you're not getting the sort of the worst case tariffs coming through, even though there are some. And so the bank proceeds and is able to cut 3 times in the near term, and we have them cutting 25 basis points at each of the next 3 meetings.
One of the big policy shifts in Ottawa over the past half year or so is the dramatic reduction in the levels of immigration into Canada, the different streams of immigration into Canada. You see negative economic consequences arising there.
Yeah, I mean, I think it flows. It depends on what variable you're looking at, Paul, because I think the overall real GDP will struggle as a result of reduced immigration, but actually real GDP per capita, which is the standard of living, and I think what a lot of people care about more, actually could improve in that context. So I'd say it's mixed on that regard, but certainly for overall real GDP, lower immigration means lower population growth and should contribute to a lower overall growth backdrop. The other sort of silver lining, I would say, from that in regards to that, is that there should be some relief on the inflation side, we think, as a result of slower immigration, in particular when it comes to rent. Rent growth has been very strong in Canada over the last few years, but we think that it's already signs of that weakening. In fact, market rents are now negative year on year, and we think that should continue to struggle as we have those lower immigration numbers coming through, both in 2025 and likely in 2026 as well.
What about mortgage resets, which is something that people have been anxious about for some time now? Canadians renewing their 5-year mortgages at rates, notwithstanding the lower Bank of Canada rates that we've seen over the past half year or so, but at rates that are nonetheless will be higher than what they locked into 5 years ago.
Yeah, so that's another great point, Paul. So it's this renewal process that we go through. The default that most Canadians have gotten over time is a 5-year fixed rate mortgage. So the people that will be renewing in 2025 are the ones that first got their mortgages or last renewed in 2020 on that that are in that cohort or in that group. Of course, interest rates were so low in 2020, so you're going to see a big increase in terms of the rates that people are paying. Could be 2.5 percentage points, maybe even more than that in some instances. And so that will be a drag on both household consumption and on housing activity. So both resale volumes and renovation activity, we think, will struggle. At this point, I don't think that will cause sort of a significant wave of defaults or delinquencies. I think you've seen some pickup in delinquencies as a result of mortgage rates resetting higher. I think the bigger, more meaningful channels for Canada will be on the consumption side and on the housing activity side that flow from it.
David, thanks a great deal. David Doyle, Head of Economics at MacQuarie Group. Stick with us. Lots more coming here on The Street on BNN Bloomberg.